Today we're talking about credit cards, using them, how to use them wisely, how to choose what works best for you. I'm Andrea Johnson. I'm the Grant and Financial Education Coordinator for the Office of Consumer Credit Commissioner. This webinar is for informational purposes only and does not constitute legal advice. A little bit about the Texas Office of Consumer Credit Commissioner for those of you who haven't attended a webinar before. We license and regulate certain non-depository institutions. What does that mean? We license and regulate pawn shops, payday loan lenders, registered creditors across the state of Texas, the entire state of Texas. We protect and safeguard consumers against abusive and deceptive lending practices, and we educate consumers like yourself and creditors about your rights and responsibilities. If for any reason you have had any issues that you would like to discuss, any concerns or complaints or comments about any of the industries that we license or regulate, please call our Consumer Assistance Helpline. We provide financial education through me, the Financial Education Coordinator, informational seminars and webinars like this one, and I am going back out there in the public, and I will be at a benefits fair in Houston on the 7th of August. So if your organization, your business, whatever it is, if you would like to see me in person, to travel where you are to give a presentation, or maybe you have like a fair or something coming up, an employment fair, please let me know. I would be happy to participate anywhere across the great state of Texas. And you can also get your financial education materials not only in the handouts that I provided today, but those can be found at occc.texas.gov. And we offer the Texas Financial Education Endowment. As a grant coordinator, I would just like to say this is very important. If you belong to an organization that provides financial education for K through 12 adults or financial coaching, you please send them my way, and we can help them apply for the Texas Financial Education Endowment Grant. The new funding cycle has just started, and I'm really looking forward to skating through all those applications. Credit cards, using them wisely, knowing which ones to pick and which ones not to pick. Again, this webinar is for informational purposes only and does not constitute legal advice. What is a credit card? It sounds like a pretty basic question. So a credit card is a revolving line of credit. It's a convenient way to pay for goods and services now and then pay it back later. However, there is always probably going to be, unless you are a billionaire, a limit on your credit card, how much you can borrow, and you always have to pay a portion of that bill every month, your minimum payment. Now, if you can make that pay more than the minimum payment, that is always best, because fighting the interest, fighting all those different things, it's always best to make more than the minimum payment if you can. So how do credit cards work? Credit cards can be an important financial tool, not just because they're there if you need them, maybe an emergency situation. It can show evidence that you are credit worthy. And being credit worthy and showing you have good credit and good credit history helps you to get a loan for a car, a mortgage, an apartment. It helps you to get better phone service. Maybe when you apply for utilities for your new place, they waive the deposit because you have great credit and you have worked on it. And a credit card is just one of those simple ways to build your credit and build your credit score. It's a convenient way to pay for purchases online or by phone. I know someone specifically, this is what they use their credit card for, because they don't want to use their debit card or bank account information when we're making purchases online or over the phone, because they've had identity theft and they're very leery of doing that. You also, when it comes to a credit card, you have the right to dispute erroneous credit card charges. You also have the right to dispute certain charges for goods and services that aren't delivered as agreed. I think of this a lot because, when you buy a new refrigerator and it shows up dented and dinged and scratched, there you go. It gives you the right to dispute it. Cards that are not credit cards, charge cards. Sounds interesting because you make charges on a credit card. prepaid cards, and debit cards. Charge cards are used like credit cards, but they don't actually involve credit. You must pay the balance every month. Of course, prepaid cards also don't involve credit. Money is loaded onto these cards, and then that's the money you use. Sometimes these are also linked to a savings account, a secured credit card. That's an example of also not necessarily a prepaid credit card, but a secured credit card where it's linked to an account, a bank account that has, let's say, $500 in it. And so that is used to pay that bill. Debit cards. And when you go to the store, you see the option a lot of times to use your debit card as a credit card. This does not mean that you're actually using it as a credit card. There is no delayed payment when you are swiping your debit card as a credit card. It's all in how it's being processed in the network. So sometimes I've noticed when I do this, when I use it as a credit instead of a debit, you'll see a temporary hold for the full amount, or maybe a temporary hold for $1. So it's just kind of checking. It's like another safety net, so to speak. What is truth in lending? The Federal Truth in Lending Act is a written disclosure that creditors must provide to you in writing. This will give you prospective credit card customers information about what's being offered, and it contains important rate and fee information. So you're going to look at it and you're going to see rates. A lot of times they'll send you a notice, you've been pre-approved for this credit card, and 0% interest on balance transfers or charges for the first 12 months. Well, it's also part of it where they have to disclose what the interest rate will be later. They have to disclose the fees, if they're monthly fees, annual fees, whatever it may be, different charges on bill transfers, charges. There's lots of things that they must include in this. What about rates and fees? Well, there is the annual percentage rate, which is the cost of credit expressed as a yearly rate. So you definitely want to look at that and see what that is. There could be a penalty APR, which is an increased rate if you don't pay your bill on time. So let's say you just kind of fall behind 1 month. Well, then you could accidentally, not by your choice, we'll say that, not by your choosing, you might be charged a higher interest rate for paying late. What about interest rates? There are fixed and there are variable interest rates. Of course, fixed is great. That means that your rate will not change until the creditor tells you in writing that it will change. It's not like a fixed rate with your mortgage or a fixed rate with your car loan. There is an option that it could fluctuate at some point, but it is fixed until you are notified. Variable rates just mean that the interest rate is going to change more frequently, and it's going to go up and down, and you might, it's going to be associated with different charges, things of that nature. So there's different things you want to look for when you're looking at these credit cards and deciding on what to do, correct? And these are what you're going to be looking at: your interest rates, your fixed or variable rates, your any penalties. I think of penalties a lot of times when it comes to personal loans. There's personal loans out there, and if you pay it off early, there's a penalty, and it can affect your credit score. Low introductory APRs. These, I admit, these have always gotten me. I am one of those people over the years that if I receive a notice that I've been pre-approved, and let's say I have a card I don't like so much and it has a high interest rate, or it has a variable interest rate, or whatever it is, I'll get these offers and they say, it's a teaser rate. So 0% interest seems to be really popular. 12 months, 18 months, for balance transfers, for charges. The problem here is that when you open a new credit card, because of the low introductory rate, of course, it does affect your credit because you've just applied for a credit card. That rate will not last. So as you're thumbing through the documents, deciding whether or not you really want to do this, look and see what the interest rate and fees are going to be after the introductory rate. So for instance, you see on the screen right now, 0% interest on purchases for 15 months. That sounds great. Then a variable APR of 15.49 to 25.49%. So those first couple of months were great. 0% interest, you consolidated some credit cards. Did you get them paid off? Because if you don't get those cards paid off and you've consolidated and you've done balance transfers, at the end of that introductory period, you will be charged interest for those consolidated cards, correct? You will be charged the back interest, so to speak, and you will continue to have interest going forward. So that's something you want to watch out for. It sounds nice in the beginning, but make sure you're going to have it paid off in that time period. Credit card fees, rewards, and grace period. Credit card fees could include your late fees, your annual fees, cash advance or foreign transaction fees, balance transfer fees, credit limit increase fees, and over the limit fees. Now, credit limit increase fees typically are when you ask for a credit limit increase. Sometimes people will ask, I got a thing in the mail that says they increased my credit limit. I didn't ask for it. That won't have a fee because the company did that, not you. And that's typically going to be something you request that's going to have the fee associated with it. Rewards. Maybe you're shopping around for a credit card with really good rewards. Make sure they fit what you want, what you need, okay? Shop around. If you don't fly, if you're not a big traveler, airline miles are not going to mean anything to you, but maybe cash back at the end of the year. You know, they send you a check, cash back for your purchases. That's a big thing. So make sure you're shopping around and looking and seeing how those things qualify. You know, do you have to make so many purchases per year? Does it have to be a certain amount per year? How do you get the rewards? A grace period. This is the time between when your statement is issued and when your payment is due. Typically, you are not going to see your credit card bill the day it's due. It should be coming in advance. They don't have to give you a grace period though, okay? So that's not something that it's not an obligation that creditors have. It's just typically what happens. What about the balance computation method? Well, this is how interest on your account is calculated. This has to do with your interest, and there are different methods to this. So the cardholder agreement will include which method is used. And I believe I actually keep this thing around. And I want to say, see this one, this little thing, it talks about penalties. It talks about, and look at that interest rate. In the chat box right now, someone says, I usually see a 24% rate after the teaser rate is over. So look at that, 29.99% for purchases on this card. This card is one that had a 0% interest rate for so many months. This one also, see, it talks about paying interest. Your due date is at least 23 days after the close of each billing cycle. If you are charged interest, the charge will be no less than $2. So there's lots of things on here that you will see. How interest is calculated. whole section, right? What we're talking about right now, how interest is calculated. We use a daily rate to calculate the interest on the balance on your account each day. That's what we're talking about right now. How they determine the balance and interest on your card. So the average daily balance you see at the bottom of the screen, paying the card earlier and with a larger payment will decrease your finance charges because they're basing it on your daily balance. So keeping that balance low will make a difference on your interest charges and how your interest is calculated. There are other important terms and features and products and services. So your credit limit. The credit limit is the maximum credit you can use, of course. Each creditor has its own standards. So they're going to be looking at your debt to income ratio. They're going to be looking at your credit history, your current income, any outstanding debt you have. I think of this a lot. I know we're talking about credit cards today. I think of this when I applied for my first mortgage and I had a lot of open credit cards. They did not have balances, but it was available credit. And so to the mortgage company, the lender, this was something she pointed out as kind of a hesitation because having all those credit cards open meant that I could possibly rack up all that debt and then I wouldn't qualify for my mortgage. There are other features to consider, like customer service fees or free features for and things of that nature that go into weighing out products and services offered with your credit card. This is what the chart looks like. This is on page 9 of your participant guide that I sent you. And you'll see, look at all the different things that you can fill out. So name of the credit card, your introductory rate and how long, what is it going to be afterward, purchases, cash advantages. This is talking a lot about the charges that you will be charged for making purchases. Your penalty APR, your annual fee, your late fees. And so you can kind of do a side-by-side comparison on the different things that are being offered. I recently received credit card pre-approval notices from a credit card company that I've had before, and I really liked them, paid them off and closed it several years ago. And I compared it to the one I have now, and there's a good chance I'm going to be closing the one I have and consolidating to the other one and going with it. Its overall annual interest rate is lower. It doesn't have any fees. It's just a more friendly, user-friendly credit card, so to speak. So it's just easy to use this chart or something similar to jot down the different credit cards offers or things that you're considering to get a really good view of what will work best for you before you commit to anything. Unsecured and secured credit cards. Unsecured credit cards, there's no collateral. Secured credit cards require collateral with a credit card. When I think of collateral, a lot of time I think of your car loan. So your car is your collateral when you get an auto loan or your truck or whatever you're driving. That is your collateral. And it means that when you don't pay it, you get your car repossessed, right? So when it comes to a credit card, you're going to keep money in a dedicated account and it may equal the card's credit limit. This goes back to prepaid cards. This goes back to a secured credit card. If you pay the balance regularly by the due date, you generally can improve your credit history and scores. So these are really good for people who are just starting out. You know, maybe you have a high schooler going out, maybe you're reestablishing your credit. You know, you've had some bad credit history and you want to just kind of build things up. This is where a secured credit card is going to help you. You know, if you're just trying to work on making your credit better, this can help you. Maybe you've had a bankruptcy, maybe you've had a foreclosure, maybe you've got some things that in your credit past that aren't too friendly. So a secured credit card would help you to reestablish that. So what about an application when it comes to credit cards? There are several different options to find credit card offers. Financial institutions, retail stores, websites, and in the mail. I get them in the mail. I get them a lot in the mail. And to the point where I'm kind of like, please stop sending me these. Now, I know that sending me a pre-approval letter, because I talk about credit and budgeting all the time, credit cards, pre-approval letters do not affect your credit score. And we're going to talk about that in a second. So just because they're sending me the pre-approval notice, it doesn't mean anything. It just means that they think I'd be a good candidate. Now, it may say all these lovely things in the pre-approval notice, but when you send in the application, the terms and things might change a little based on their other credit disclosures that they have. Application terms. So the applicant, you or I, the creditor, the company, the individual credit, joint credit, and an authorized user. So an authorized user, this is a tricky bit, because an authorized user can use the card and they can make purchases on the card, but they are not the primary account holder. So they can't make changes to the card. They will probably be issued a credit card with their name on it, but the account belongs to the primary card holder. I mention this because if you have a credit card and you want to put someone on as an authorized user, A, it's not helping their credit. B, it could affect your credit because they could be racking up debt that you're not aware of. And then you're the one stuck paying it off because you're the primary account holder. Now, if you're getting lots of pre-approval offers, you can opt out. There's a phone number, there's a website, so you can go ahead with the opt-out process and not have to deal with getting all those approval letters in the mail. Managing your credit. Credit cards can be convenient, but manage them carefully to keep costs down and avoid damaging your credit because, for instance, credit inquiries stay on your credit report for 2 years, and that will bring your score down. What is reading a credit card statement? And I kind of, I showed you guys this one earlier. So when you look at it, there's the account billing cycle, there's going to be the account summary, there's going to be payment information. So it's going to show you all these different things on the statement that you're going to hopefully be keeping track of. So for one, you don't see any erroneous charges, charges you didn't make. I have my credit card that's linked to my bank account. It pops up and gives you notifications when it suspects that something suspicious has happened, correct? So that's really helpful. I don't necessarily have to wait for my notice to say, oh, you have a statement. I also obsessively check my accounts online. So it's another thing to do when you have a credit card and you're trying to keep track of it. Make sure you are signed up for online, so you can look at it online and keep track of it that way as well. More items that might appear on your credit card statement. There's a credit counseling statement because that's part of Truth in Lending. They have to supply you with that kind of information. It's, kind of like, so I know in some instances, if you're playing the lottery and you go to a lottery website, there's actually disclosures and paperwork and documents and pamphlets for people who have gambling problems. So it's kind of in the same realm of, here's your credit card. We're so glad you're borrowing money from us, but just in case you need credit counseling and it's gotten out of hand, here is this to help you. There's going to be a notice of interest rate changes. So we talked about variable, right? So your variable rate could change and your fixed rate could even change, but it's got to be a notice. When it comes to fixed, it just can't happen. They have to tell you. Transactions and count activity, of course. That'll include transactions, finance charges, annual fees, and interest totals. your interest charge calculation. Like we mentioned earlier, this one is this little interest. I mean, it has its own section right here, how interest is calculated, and it goes all the way down and shows how they calculate interest with this card. So that's a big part of it. How payments are applied to your balance. This is another thing to consider. I have one that's zero interest for tires, I believe. And recently I needed to replace a tire, and I still have that credit card that has zero interest to get it paid off. And I was about to just go, and they go, "Oh, do you have this credit card?" Because it's the retailer that I got it from. I was like, "Oh, yeah." And I was about to charge the new purchase. That new purchase doesn't get 0% interest because that new purchase would have been, I think it was less than $70. But I just, they said it and my brain clicked, and then I went, whoa, 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 whoa. Never mind, never mind. And used my debit card to pay for the replacement tire because I know that what's on that card right now has 0% interest for so many months if I get it paid off for that initial purchase. Making a purchase on top of that, that new purchase will have the other interest rate. And that I do not want. So when you make the minimum payment, going back to this, when you make the minimum payment, the creditor chooses how to apply your balance. It's often applied to the portion of the balance with the lowest interest rate. Often applied. Doesn't mean it is, it doesn't mean it will, it's often. It might happen. Amounts over minimum payment. So generally, this is applied to a portion of the balance with the highest interest rate. So when you make a payment, generally it's applied to the portion of the balance with the highest interest rate. So what does that mean? I talked about those different things. I've got a charge that has 0% interest for so many months. If I had made another charge on that card, it did not fall under the 0% interest month. So it's two different, same card, but it's two different charges, and they fall under two different interest rates. They fall under two different payments. They fall under two different, it's like having two cards on the same account number, so to speak, when you're making those payments. Paying only the minimum payment. Look at this graph. So sometimes the numbers astound me when I look at this. So let's say you spend $500 on a TV and the credit card APR is 18%. 18% on all these purchases. The interest paid $132. How much you really pay for the item? $632 if you make the minimum payment over 3 years. Let's go down to that furniture. That's the one that's most shocking, right? So $2,500, the original cost of the furniture, 18% interest. Interest paid $5,363. How much you really pay? $7,863. And if you make the minimum payment, you're paying it off in 23 years. 23 years to pay off that sofa. Really think about it. This is probably one of the holdups I have when it comes to replacing our sofa. The sofa we have, I paid less than $1,000 for it. I love my sofa. I'm very attached to it. And when I look at furniture prices these days, I just can't commit. And this is probably why, because just the idea of how much I would have to pay if I don't pay it outright to begin with. Paying more than the minimum payment. This is much better. So this is that same $2,500. It's probably because it's the sticker shock of things. So with the minimum payment plus $24, look at that. You have just cut the years down drastically. We went from 23 years to pay off that sofa to 4 years to pay off that sofa. Interest, $1,000. Great. Let's look at the minimum payment plus $41. We're paying it off in 3 years. We are only paying $754 in interest. The total amount paid, drastically different. This is what you want to look at. This is what you want to consider. This is where you don't want to just agree and commit to all kinds of different things, correct? What about debt repayment? This is a big thing when it comes to credit cards. So there's the debt snowball. This is paying the minimum payment on everything, and anything extra goes to the smallest balance. What does this mean? This means you tackle the card with the 200 balance regardless of the interest rate. You go after it and you pay the minimum payment on those other cards with the high interest rate or the higher balance or whatever it may be. What I like about the debt snowball is that I feel this is something that would be quicker. You get that immediate gratification of having that card taken care of and gone. Then you go after the next one. What about the debt avalanche? This is paying the minimum payment on everything, regardless of the balance, and paying anything extra to the highest interest rate. The highest interest rate. What are we fighting here by paying the card with the highest interest rate? We are fighting those high interest rate charges. Get it paid off. Stop giving them your money, extra money. What about consolidating your credit cards? Of course, again, balance transfers sound great. There's usually those lower introductory rates, but you want to watch out for the fees because after that time is over, the introductory time is over, what fees are associated when you haven't paid it off at the end of the 12 months or 15 months or 18 months or whatever it may be? If you haven't already stopped using credit cards or other debt to finance living expenses, you need to. If you're running into a cash crunch at the end of the month or right before payday, figure out why. Figure out a budget. I have a budget worksheet included today. Make sure if you can, allocate extra money to pay off your debt. I met someone recently who, while she does have a great job, she specifically took up a part-time job to pay off her student loans. Every penny that she got from that second job went towards paying off her student loans. She did not start including it in her regular income. It specifically went to paying off her student loans. Ask for lower interest rates. This one I'm like, okay. But I've had people contact me and tell me they actually did this. They called around, they asked their creditors and asked for lower interest rates, and they got them. And so that's something you can do, and that's something you should always consider because all you're going to get is a yes or a no. We're talking about credit cards today. What do you need to do? You need to check your credit. Credit bureaus do not make lending decisions. They only are holding the information for the creditors. So this is why it's important to check your credit score. You want to see if those cards are on there. If you've applied for that TJ Maxx card, if you've applied for the Sam's card, if you've applied for an Amazon card, you've applied for all these different credit cards, and then you look and you go, well, I didn't apply for an Old Navy card, and it's on your credit report, but that card never came to your house. You need to figure that out, right? You need to make sure those cards belong to you. You need to make sure anything on your credit report is your credit history and not someone else's. You need to check your names that you've had. You need to check your employers' addresses, any accounts that you've had open, any accounts that you've had closed, judgments, liens. You need to look so that you can dispute that information and work on your credit history and credit report and credit score, correct? Because if anything there is incorrect, then you need to dispute it. And that's a process. You find something, you contact them, it takes 30 days for the creditor to respond. Then you have the option to, again, say your piece, so to speak. Checking your credit does not impact your credit score. People ask me this all the time. It is a myth. Checking your credit is something you're doing. It does not affect your credit score. Pre-approvals, they're not affecting your credit score. Those credit applications, yes. Once you fill out the letter, send it back in, it becomes a credit application. The creditor then checks your credit. That inquiry is on your credit for 2 years. And if you're looking at the screen right now, Experian, TransUnion, Equifax, they are all offering through April of 2022, they're offering you the opportunity to check your credit once a week for free. So you should check it. This goes back to another question. I have a screen over here with the questions. Someone says, do I have a credit score if I don't have credit? How do I check it? You do have a credit score if you don't have credit. If you don't have credit, it's typically not the best credit score. But you say you don't have credit. You say you don't have credit cards. Do you make a car payment? Have you paid off a vehicle? Do you pay rent? These are things that go into your credit report. Have you always, when you've moved, have you always paid your utilities and not left any outstanding accounts? So what do? You go to Experian, you go to TransUnion, you go to Equifax. Someone recently told me also that Experian offers Experian Boost, and that is where I looked into it, and you can actually put your account information for things that don't show up in your credit score, your credit report, your credit history, like I think they're doing streaming services. So you're paying your streaming services each month. You know, your Netflix, your Disney, your Amazon, whatever it may be, Hulu, the Peacock. I mean, there's so many things out there nowadays when it comes to streaming services. And Experian is doing Experian Boost. And what that is so you're going to input your different things that you are paying for each month regularly, routinely, on time. And that will help build your credit report, because typically things won't show up unless they were paid in full and they were good. So those are good marks. And they'll show up if they were bad. So your Netflix account doesn't show up until you stop paying it. Then it becomes a negative mark, right? So that can affect your credit score. So go to any of those websites and you can get your credit report for free, and once a week through April of 2022. What about steps to managing your credit cards? Keep good records. That goes back to checking your credit. That goes back to keeping a log of what cards you have, things you opened, things you didn't open, things that have been closed. Check your statements for mistakes. Make sure there aren't any typos in your name. I'm Johnson. What if it says Johnston or Johnson with an E instead of an O? That's a problem. It may not seem like a big problem, but it's a problem. It needs to be accurate. Pay your credit cards on time and try to make at least the minimum payment, if not more. Understand the impact of different payment strategies. So those different things we talked about with debt, debt snowball, debt avalanche, those things of that nature. Try to limit what you owe compared to your credit limit. What does that mean? That means I have a $5,000 credit limit. It'd be nice if you only owe less than $200. So those two things are, that's looking pretty good, because you're not maxing out that card. You're not fighting an interest rate, because what could happen is, let's say you max out the credit card. You have a $5,000 limit credit card. You've maxed it out. Guess what happens? The interest rate charges push you over your limit. Just the interest rate alone, just the interest charge alone can push you over the limit, and you will be charged fees. More than likely, you will be charged a fee. I'm Andre Johnson. I'm the Financial Education Coordinator for the Office of Consumer Credit Commissioner. If I didn't answer any of your questions today, or you have more that you want to send me, you can email me at financial-education@occc.texas.gov. You can also find us on Facebook at Texas Financial Education Endowment, or on Twitter at Financial Ed Texas.